start with derivative. So we'll understand what is derivative. So first decode this word derivative. So it derived from the word derive. So you can say that derivative does not have its own value. Its value is derived from its underlying asset. So what is underlying? So suppose take example of crude oil. Okay. So from crude oil we can make petrol, diesel, rocket, anything. So petrol doesn't have its own value. Okay, you can include the processing or that charges, but the main value it derived from the price of a crude oil per barrel. So petrol is a derivative product of crude oil. So because petrol does not have its own value. So same way in financial market there are four types of derivative. First is futures, options, forward and swaps. So let's decode one by one. So I will take futures and forwards together because it's almost similar. So let's take an example. So suppose there are two parties. You can check my mouse and this sell active sell. So there are two parties, farmer and company A. So what happen? Farmer produces onion, and after next 3 months, so suppose company A. So company A will go to the farmer and make a contract with him that he want to buy X, yeah, X, or you can say 1,000 kilo of onion at 100 rupees per kg, or whatever may be produce. So he is deciding the price today for the next 3 months. Okay, regardless of whatever be the market price at that time. So there will be two scenario after 3 months. So market price that after 3 months. Suppose today is January, then February, March, April. So in April the price might be, you can say that the 150 rupees per kg, or it might be 50 rupees per kg, anything can be happen. Okay, so if the price is 150 rupees per kg and the company is contracted with farmer at 100 rupees, so whatever may be the price, company is going to pay 100 rupees per kg to farmer. So in this case what happen, market price is 150. So if a company today go to the market and try to buy the onion, it will have to pay 150. But company A already contracted with farmer 3 months before that he will buy at 100 rupees. Then company A is a profit of 50 rupees today. Same that can happen that prices might be fall because of overproduction or anything. So suppose if the market price is 50 rupees, so in that case farmer is benefited because company has to pay him the 100 rupees per kg price. So this is the scenario. So why this came into picture? Why company decided or farmer decided to do this before? Because firstly understand there are two things that happen. They have predetermined the price and they have fixed the date in future. Okay. So in derivative I can say in features and forwards there are two important things. First is price and second is date. It is predetermined. Okay. The second, let's look this why they are doing this. So because of hedging the purpose. Okay. So features are primarily used to protect against the unfavorable price movement. So the either farmer or the cat company doesn't know what going to happen after 3 months. Okay, the price can be fall, can be above, but they are going to stick to the price so that they both the farmer and company both will be in a position to in a favorable situation. We can say that. So sometimes traders use this option to speculate on the direction. Sometimes arbitrage opportunity. There will be arbitrage means there might be a price gap between the two. So you can say that traders exploit the price difference between the future contract and the spot market to risk free profit. It is a another way. So we can say that future and forward, what is the difference? So futures are traded in the exchange. So like NSE and BSE, they are traded. So they are we can say standardized, but forward not traded. They are OTC, over the counter. So Mr. A and Mr. B can make contract for themselves. So they can choose any condition. So it is called tailor made. but it is but in future terms are fixed because exchange have to decide what is this. So margin, they have to pay the margin because uh, in here in forward, and Mr. A or Mr. B, anyone can be default, anyone can do default, but there is no legal body to take action against them because it is over the counter, because it is between the two parties. But here the exchange or clearing houses are the take the responsibility to clear the trades. So that's the main difference between futures and forward. Other things, everything is simple or same. So let's take a real life example. So TCS current price is 1,000 rupees per share, okay, and have hundreds quantity of TCS share I'm holding it. So there might be the possibility that I get some news that and maybe this news is bad, so that might affect the share price and it can be fall. But I am holding TCS share from long time. I have uh, buy about it at a very less price, so I don't want to sell because of that news. Okay, because I want to be the long term holder. So what can I do? Because uh, I assume that price going to down, so there will be notional loss for me. Okay, so mitigate loss. I will go to the future market and I short sell the 100 quantity of TCS in derivative. Suppose 1 lot is equal to 100 quantity, so derivative we cannot sell in shares, we can sell in the lots. So for example, I am taking one share, one lot is equal to 100 shares. So I go to the future market, I have shorted the TCS current price in derivative. Suppose this also be 1,000, so I have shorted the 1,000. So what happen if the price go down? Suppose price go fall to 900. Okay, then in equity cash position, I have my portfolio will fall down to 100 rupees per share. So 100 into 100, so maybe 10,000 rupees. I am seeing loss in my portfolio. But other way, I because I already shorted the derivative. So short means we have already sell. So what happen if market price fall 1,200 and so 100 rupees? So I will be in a profit of 100 and 200, like 10,000 shares, 10,000 rupees. So I'm neither in loss neither in profit. So that is the use of derivative to hedge something. So now you understood what is the derivative. Now we'll check the options quickly. So option is a contract that gives you the right but the not the obligation to buy or sell something. Let's decode this because it might be the difficult to understand the definition. So let's decode this. So imagine if you want to buy the pair of shoes or sneakers, okay, but you don't have money right now. So you to go to the store and ask the manager that I will pay you 100 rupees, okay, and I will book this uh, sneaker or shoes, okay, and that time the price might be the 1,000 rupees, and I ask that I will come to next week and I can buy this. But what happened? So there are two things. So I have right but not obligation. So what is right? Okay, because I have paid 100 rupees premium to book. So the seller, I am a buyer. Okay, he's a seller. The seller has the obligation because if I have right, because I can say that I have paid you 100 rupees token, so you have to give me if I want to buy. Suppose, but there is no obligation at this my side. I am a buyer. Okay, so what can happen? Because after 1 week, if I'm getting that same pair of shoes at 800 rupees somewhere else, and he is giving me at 1,000 rupees, then I will not buy from him. So in that case, my 100 rupees paid as a premium will gone. Okay, but still I'm in a profit because if I paid if I get paid 1,000 rupees to him, so and now I'm getting it for 800, so I'm getting 200 rupees less from anywhere because I already paid 100 rupees, so my benefit will be the only 100 rupees. So that's the, I can say, option. uh, Best part of the option means, so in easy way in real life, option means if we want to choose more than one choice, one two three, so you have option that in that case. So that's how option buyer have the right, okay, that he is right because he had paid premium, but not the obligation. So because if he getting somewhere else in cheap, he will say okay, take my premium and don't execute the contract. So let's see in the real life. So call option, there are two main option, call option and put option. Call option give holder the right to buy the underlying asset, okay, because I already told you that this is a derivative. So derivatives price will always be depend upon the underlying asset. Same, the put option give holder the right to sell the underlying option. So there is a difference. You can see buy and sell. There is only one difference, put and call. So if I think that the share price will go up from here, so I can buy the call option. But if I said okay, the price is going to be fall, then I can buy the put option. The same example we can take of TCS. Current market price is this, and if I thought this is going to fall, then I will buy the put option. Or if I assume that it will go up, then I will buy the call option. So because in derivative, sorry, in future, we can buy at that price. There is only one price, that price we can buy, but here we have to buy at a strike price. So what is strike price? So this is the current market price, 1,000 rupees. So strike price, they are between the some gap. So some, for some share it is a 50 rupees gap, for some share it is a 100 rupees gap. So maybe for some share it may 900, 800, 700 like that. But suppose they are 50, they are traded in 50 rupees gap. So this is current market price. So I have noted three price above and three price down. Okay. So for call option, so we have to pay premium. I already told you that we have to pay premium always. So for let's assume for call option and put option, that for current market price this is 20 rupees, if we can assume that. So I assume that market will go up, then in that case I will buy this one, okay. But anything I can buy, but you can see the difference, premium is high, okay. Why high? Because it is uh forget that, because we are buying call option, so we can focus here. So if we assume that market is going to be go up, then in that case this premium is going to be increased, okay, vice versa. So in 1,000, if I bought this and then market goes to 1050, 1100, 1150, then this price is going to be increased, okay. How? Suppose that uh, at that time, if I bought at 900, at that time the premium might be 20, but now market is trading at 1,000. So if I bought 2 days or 3 days ago at 900, I paid 20 rupees as a premium, but after price goes up to 1,000, the 20 converted to 30, so I have been a profit of 10 rupees per share, or per lot, or sorry, anything. So I am in a profit of 10 rupees. So same, if it goes to 1,050, 1,100, this price is going to be increased. So that's how it works. So this, we can say there are three: in the money, at the money, and out of money. Okay, so it called the moneyness in option. So at the money what? Because this is the current market price and this is the current premium. So it is the at the money. Okay, and in the money. In the money means we are buying 900 rupees target price at a 30 rupees. Okay, why we are saying in the money? Because this, this already crossed the 1,001. So suppose in the money means the, if you buying the strike price which is already surpasses that current market price, we can say in the money. And out of the money, it is like if I buying 1,100 strike price, then it is out of money because the market is still not, or the price is still not reached here. This is out of money, this is in the money, and this is the at the money, okay. Then for put option it is different, because you can see it is a vice versa. Because in put option the market will fall, then I will get the profit. The same, it is a reverse one. So at the money will be the same, okay. Then let's suppose in the money, in here case in the money is this one. So but here in the money is maybe 30 or 25 below that. Why? Because we are going reverse now. So if we sell at 1100, so we are in the money because market is 1000, and this will be the out of money because price is still yet to be reached here. So that is the main thing. In the money, at the money, and out of the money. These both are different in call and put option. So be careful that. So what will be the maximum loss? The maximum loss here you can see, we can see that the premium paid the 100 rupees. So 20 rupees will be the maximum loss because in call option, if we have predicted that market going to be up, but suppose market fall in any level, then my maximum loss is 20 rupees. And profit unlimited because if market can go 2000 5000 anything hypothetical, but my profit is unlimited. So that's the best part of the option. So I hope you understand this, so we can uh, check swap later because it's a totally different. So I hope you understand this. If you want it out, let me know. Thank